Welcome back to the deep dive. So we have a monumental stack of sources in front of us this week. I mean, everything from SEC filings, legislative reviews, all the way to raw crypto market data.
A lot to get through.
It is. And our mission, as always, is to cut through that noise, find the signal, and give you that strategic advantage. Today, we're doing a really critical two-part deep dive. First, we are going to map out the new regulatory playbook that has, well, finally solidified in the United States as we head into 2026.
And this isn't just talk anymore. This is actual law.
Exactly. And second, we're taking all that macro clarity and we're going to zoom right in on a single fascinating case study, the Shiba Inu, or SHI ecosystem.
Right, trying to see how a project born from a meme is trying to pivot to, serious infrastructure.
Under this new regulatory glare, yeah.
And what's really central here, the main themes for you to take away, is that the entire U.S. regulatory posture has transformed. We are past that adversarial litigation phase of the early 2020s.
All the courtroom drama?
All of it. Now, in 2025, 2026, we are operating under concrete governmental acts. We've moved from just rhetoric to an actual operational framework the industry can read.
But just to be clear, there isn't some new legal category called cryptocurrency, right?
No, not at all. That's the baseline we have to remember. A token can still be a security, a commodity, a payment tool, and property all at the same time.
So what changed?
The change isn't what these things are, it's how those categories are administered. It's a playbook that people can actually understand and follow now.
Okay, let's unpack that playbook then. And it really starts with the foundation of modern crypto finance, stablecoins. Section A brings us the Genius Act. It's the Guiding and Establishing National Innovation for U.S. Stablecoins Act.
Quite a mouthful.
It is, but it's the first real federal framework for them. Before this, everyone was just guessing. So what does it actually demand?
It boils down to three core things that, frankly, just make everything safer. First, the reserves have to be held in high-quality liquid assets.
So like short-term government treasuries, not risky commercial paper.
Exactly. No exotic, illiquid stuff, just safety and soundness. Second, there's mandatory monthly reserve reporting.
Okay.
And these reports have to be examined by a registered public accounting firm. But here's the kicker. The CEO and the CFO have to personally certify them.
So real personal liability. Skin in the game.
It puts accountability squarely on the people running the show, not just some algorithm.
But doesn't regulation like this just grind everything to a halt with bureaucracy? What about speed?
That's maybe the most innovative part. Regulators now must decide on a complete application within 120 days. And if they miss that deadline,
what happens?
It's deemed approved.
Whoa.
Yeah, it forces the agency's hand, prevents that regulatory limbo that plagued the market for years.
So what was the result of all that certainty?
A huge institutional impact. The sources are clear on this. The total stablecoin market cap just soared past $250 billion by the end of 2025. This wasn't just retail money.
This was banks, payment firms.
Right. Global corporations finally had a compliant path to use dollar-pegged digital assets.
Okay, so that handles the money movement. Now, what about everything else? All the non-stablecoin assets. That brings us to the Clarity Act.
The Digital Asset Market Clarity Act of 2025.
Yes.
This is the big one that finally ends the turf war between the SEC and the CFTC.
How does it do that?
It draws a bright line, a legislative one, between an investment contract, which is the security sale, and the underlying investment contract asset itself.
Okay, so selling a token to fund a project is a security transaction.
Potentially, yes.
Yeah.
But the asset itself, once the network is built and decentralized, might become something else. It can transition.
How?
The Act creates a certification process for what it calls a mature blockchain system.
Okay.
Once it's certified as mature, that token can then trade on secondary markets as a commodity under the CFTC's jurisdiction, not the SEC's. It also finally defines digital commodities.
But wait a minute. If an asset has to get certified as mature, doesn't that just create another hurdle? One that maybe favors the big, well-funded players over new, decentralized innovators.
That is the number one critique, absolutely. The criteria for maturity are pretty strict. You have to prove decentralization, wide distribution.
Right.
But the idea was to create an off-ramp from being classified as a security forever, which is what the industry was desperate for.
And it also provides some big customer protections, I saw.
Huge. It mandates segregation of customer assets.
Yep.
And it explicitly prohibits using customer funds for things like staking without their permission.
So the FTX situation
would be explicitly illegal under this new commodity framework. You want to use a customer's Bitcoin for yield. You need their express written consent.
That's a massive step for trust. Now, this all seems to be mirrored by policy shifts like Executive Order 14178.
Yes, January 2025, strengthening American leadership in digital financial technology.
Yeah.
And it sent some very strong signals.
Like what?
First, it explicitly prohibited the federal government from developing a central bank digital currency. It just settled that whole debate.
Wow. Okay.
Second, it committed the U.S. to protecting access to open, public blockchains, and crucially, preserving the right to self-custody.
Holding your own keys.
The government said, that's a right. And then the Department of Justice issued this memo, ending regulation by prosecution.
That sounds significant.
It was a total reset. It basically tells prosecutors to stop using criminal tools to figure out if something is a security or a commodity. Go after actual fraud, sanctions evasion, theft.
Not classification disputes.
Exactly. And the banking regulators heard that loud and clear.
Right, because the Fed sunset its novel activities supervision program.
They did. They basically said, okay, crypto is normalized now. And at the same time, the OCC confirmed that national banks can custody, settle, and execute digital asset trades for clients.
So the banks are fully in, the integration is complete.
The whole system is integrated now.
So even while the new laws were coming online, the courts were still firming up the boundaries.
Oh, absolutely. The legal system was calibrating in real time. The cornerstone is still that final judgment in SEC v. Ripple Labs, August 2024.
What did it finally confirm?
That programmatic sales on open exchanges were not investment contracts. Selling to institutions could be a security sale, sure, but the public trading that asset on a secondary market, not a security transaction.
And that blueprint is now locked in, right? Because the appeals were dropped.
Dismissed in August 2025. It's done. That clarity is now an irreversible part of the industry's legal foundation.
And that case settled the security boundary, but another one tackled sanctions and code.
Right, Van Loon v. Department of the Treasury. This was about Tornado Cash.
The mixing service.
Exactly. And the court held that the immutable smart contracts themselves were not sanctionable property under the law. You can't sanction code the same way you sanction a person or a bank account.
What did that lead to?
It was huge. OFAC, the sanctions body, had to remove Tornado Cash from the SDN list in March 2025. It sets a massive precedent for how sanctions can apply or not apply to decentralized protocols.
So, with the courts and Congress setting these guardrails, how did the SEC itself adapt?
They had to change. They created what they call Crypto Task Force 2.0. And its job wasn't to sue people, but to craft workable registration paths and disclosure models.
A proactive approach?
The directive was clear. Move away from regulation by settlement and create rules people can actually follow.
And they also changed that weird accounting rule?
Yes. They rescinded Staff Accounting Bulletin 122. That rule forced custodians to list customer crypto as liabilities on their own balance sheets. Getting rid of it was a small technical fix that made a huge difference for institutions wanting to offer custody.
And all this convergence is what really opened the floodgates for institutional products like ETFs.
Absolutely. The Clarity Act gave the CFTC a path to regulate spot markets, and the SEC just ran with it.
So by late 2025, we had Bitcoin and Ethereum ETFs under a generic standard.
And then came spot ETFs for Solana, XRP, and Litecoin. It just signals that the market structure is finally mature.
Okay, so regulatory clarity has arrived. The institutions are here. Now for the real test. How does a project born from, let's be honest, speculative fun handle this new world? Let's talk Shiba Inu.
Let's do it.
All right, SHIB. I mean, we all remember its origin in 2020 by Ryoshi, pure meme coin. But here we are, October 2025, and it's still got a market cap near $5.9 billion.
And it is trying to make that ultimate pivot from hype to infrastructure.
So what does that infrastructure actually look like?
It's built around a tri-token model on their layer 2. You've got SHIB, the main currency, Bone, which is the gas token for their L2, Shibarium.
And also for governance.
And governance, yes. And then Lish, which is a low supply token for exclusivity. But Shibarium, their L2, is really the make or break factor here.
Designed to lower fees, speed things up.
Right. And technically, it works. Shibarium has processed over 1.5 billion transactions.
Wait, hold on. 1.5 billion transactions. That sounds incredibly successful.
It does. But here's the disconnect the sources point out. Despite that massive volume, the total value locked to TVL, the actual money in the system's apps, is tiny. It's hovering around $1 million.
1 million? That's a staggering contrast. It's like a 6-lane highway with almost no cars on it.
That is the perfect analogy. The infrastructure is there, it functions, but the capital, the Series DeFi users, they haven't moved in yet.
So this brings us to the elephant in the room, the supply. 589 trillion tokens. Can the burn mechanism really make a dent in that?
I mean, that is the ultimate battle between community hope and cold, hard math. The burn engine is tied to utility. 70% of the bone gas fees from Shibarium get converted to SHIB and burned.
So more use equals more burn.
It's the only lever they have.
Yeah.
And we just saw it get pulled hard. On January 1st of this year, 2026, the burn rate spiked over 10,000%.
10,000%.
10,728% to be exact. It removed over 172 million SHIB in 24 hours.
Okay, 172 million sounds like a lot, but against 589 trillion.
Yeah. It's a drop in the ocean. The total burn to date, even including Vitalik Buterin's massive initial burn, is about 41% of the original supply.
Which is significant long-term.
Very significant for long-term scarcity pressure. But yeah, achieving a price like $1 or even a penny is still mathematically, well, unrealistic. It would require a market cap bigger than the global economy. The burn helps, but it's not magic.
So let's talk about the roadmap. There's a big upgrade plan for Q2 of this year that is supposed to drive that utility.
This is their big play. They're planning to integrate fully homomorphic encryption, or FHE.
Okay, fully homomorphic encryption. Can you translate that for us?
Think of it like a computational black box. It lets the blockchain process transactions and smart contracts without revealing the underlying data.
So the network can confirm a trade happened, but you can't see who did it, for how much, or what asset.
Exactly. It brings native on-chain privacy. And it's critical for attracting institutional DeFi users. Hedge funds don't want their entire trading strategy visible on a public ledger for competitors to see.
Right, that makes sense. So this could be the feature that finally gets cards onto that highway.
That's the hope. That's the whole bet.
Okay, so as SHIB tries to make this pivot, the market forecasts for 2026 are, unsurprisingly, all over the place. What are the bullish signals?
From a technical analysis standpoint, things look pretty good. A golden cross is forming. That's the 50-day moving average crossing above the 200-day.
Which is historically a pretty strong bull signal.
It is, and we're seeing whale accumulation hit a 6-month high. Big holders are buying. The supply on exchanges is also down 14% over the last year, which means less immediate sell pressure.
And what are the price targets on the high end?
Short term, some are projecting up to 0.00001019.
But the downside risks are still very real.
They're structural. The supply, as we said, is just oversized. And the asset is still incredibly volatile, very dependent on speculative sentiment. It's a high-risk satellite asset, not a core holding.
And one source was particularly bearish.
It was. A flat-out prediction that if Shibarium's TVL doesn't grow substantially, SHIB could plunge by 50% or more this year.
And they drew a really interesting parallel to XRP.
They did, because XRP has total legal clarity now, but it still faces a utility problem. The Ripple payments network doesn't actually require banks to use the XRP token.
And Ripple launched its own stablecoin.
Exactly, Ripple USD, which could even cannibalize XRP's use case. So you see identical predictions for XRP, a potential 50% plunge. It proves that legal clarity is not enough. You need real sustained demand.
So we've seen this landscape completely normalize, moving from, courtroom chaos to legislative order. And we've seen the incredible tension that creates for a project like Shiba Inu.
The path is so clear now. The macro environment is institutionalized. The Genius Act, the Clarity Act, a new focus at the SEC. And at the same time, you have SHIB making this determined technical push for real utility with Shibarium and this privacy upgrade.
A real pivot.
It's a massive pivot. And the fundamental question for you, for everyone watching this space, is can that technical innovation and community-driven burn finally overcome the raw financial reality of that massive supply?
Can it attract the capital, that missing TVL, to actually compete with the big established L2s?
That's the entire question.
That is the core conflict. So here's the provocative thought we want to leave you with. Given that regulation is now clarifying the rules of the crypto game, which lets the big institutions in, what new metric, something beyond just price and Twitter hype, will you use to decide if an asset like SHIB is actually winning that transition? The sources we dove into today strongly suggest you need to start tracking Shibarium's utility metrics, that total value lock, that transaction growth, just as closely as you track the golden cross on the cards. We'll dive back into your sources soon.